Every nation on earth carries debt. It is a statement so simple that it almost seems trivial, yet beneath it lies a paradox that has confounded economists and statesmen for centuries. If every country owes money, who actually holds the claim to these debts? The question is not merely one of arithmetic. It is a question of trust, of perception, and of the intricate structures that humans have built to manage value over time. Debt, in its simplest form, is an agreement between a borrower and a lender. One party receives resources in exchange for a promise to repay in the future. But when the borrower is a state, the consequences extend far beyond the individual. Nations borrow to fund wars, infrastructure, social programs, or even the simple functioning of government. And because states cannot simply vanish, creditors have long assumed that repayment is almost certain. Yet, when every state is indebted, certainty becomes an illusion. To see why, we have to go back. In early human societies, debt was personal and tangible. A farmer might owe grain to a neighbor, a village might owe labor to a king. The concept of interest itself was often limited or morally constrained. Ancient Mesopotamia records the first codified debts, tied to silver or grain, and enforced by the authority of the temple or the crown. A debtor could, in extreme cases, be enslaved. Yet these debts were always between distinct parties. Someone somewhere had what another lacked. The transformation from personal obligation to national obligation was gradual but profound. During the Renaissance and the early modern period, Italian city-states developed sophisticated systems of government bonds. Venice, Florence, and Genoa borrowed from wealthy families to finance wars and maintain trade networks. These bonds could be traded, bought, or sold. They were among the first examples of debt as a marketable instrument rather than merely a moral or legal claim. England and the Netherlands refined the system further. The establishment of national debt allowed governments to raise extraordinary sums without immediate taxation. In England, the creation of the Bank of England in 1694 formalized the relationship between state and creditor. A government could issue a bond, pay interest annually, and defer repayment of principal. Creditors were, in essence, betting on the continuity of the state. Yet even in this early period, the danger was clear. If the state failed, the value of these claims evaporated. Defaults, partial or complete, were not uncommon. By the 20th century, the scale had expanded to an almost unimaginable level. Nations borrowed not only from domestic banks and citizens, but from foreign governments and international markets. Wars, depressions, and reconstruction programs led to layers of interlocking obligations. When World War I ended, Europe was not just physically devastated, it was financially entangled. Germany, in particular, became the focus of reparations, while France and Britain relied on American loans to stabilize their economies. Money had become a global web, with no single starting or ending point. Yet the question persists. If every country owes money, can there be a true creditor? And more importantly, what does it mean for the stability of this system? The modern debt system is simultaneously simple and intricate. On paper, a government issues a bond. An investor purchases that bond, providing funds to the state. The bond promises a future repayment with interest. In reality, the buyer may be a bank, an insurance company, a pension fund, or even another government. Bonds are often traded in secondary markets, passing through multiple hands. What was once a direct promise now becomes a claim that can be layered, repackaged, and shifted. The original lender may no longer exist. Central banks add another dimension. A central bank may purchase government debt directly, effectively creating money to fund the state. This is the essence of modern quantitative easing. In theory, the state now owes money to its own central bank. The bank, in turn, is an arm of the state. This leads to the strange but important conclusion: part of the debt of every nation is owed to itself. It is both real and symbolic, a reflection of the state's ability to create, manage, and enforce currency. Foreign creditors remain crucial. Countries often hold foreign debt as a reserve or as an investment. For example, China holds significant amounts of U.S. Treasury bonds. Japan holds a mixture of domestic and foreign securities. These claims are counted in trillions of dollars. They are not mere numbers. They represent influence, leverage, and the ability to apply pressure through financial channels. Yet these international obligations are rarely absolute. Currency risk, political instability, and the sheer scale of global finance mean that default or restructuring remains a persistent threat. History has shown that even large, seemingly invulnerable economies are not immune. Debt, therefore, is less a finite transaction than a system of trust. Bonds are symbols of confidence in a government's ability to tax, to regulate, and to maintain order. When trust falters, yields rise, signaling higher perceived risk. When trust is strong, debt can be issued at astonishingly low interest rates. This is why, paradoxically, the most indebted nations often borrow more cheaply than smaller, less indebted economies. The illusion of solvency becomes reality when the market collectively agrees it will be. This network of obligations is also recursive. Banks buy government bonds, pension funds hold them, central banks manage portions of them, and governments borrow again against new issuance. Each step is justified by the expectation that someone, somewhere, will honor the promise. But if every nation is indebted, if every central bank is holding obligations that are, in essence, claims on itself or its peers, then the idea of an independent creditor begins to unravel. The system relies on continuous growth, on the expansion of the economy, and on the maintenance of confidence. Absent these, the chain is fragile. One can observe this pattern in crisis after crisis. The Latin American debt crisis of the 1980s, the East Asian financial crises of the late 1990s, the European sovereign debt tensions of the 2010s, all demonstrate that the collective web of obligations is sensitive to perception. No single country caused the system to wobble. It was the belief that the chain might fail, magnified through financial markets, that created instability. When viewed from this perspective, the creditor of the modern world is not a person, nor a bank, nor even a nation. The creditor is the abstract expectation of repayment. It is confidence itself, codified in contracts and reinforced by centuries of institutional trust. The bonds, bills, and notes circulating globally are physical manifestations of collective belief in the stability of human governance. This leads to an unsettling observation. If faith falters, debt can vanish like mist. Hyperinflation, default, and restructuring are not the result of mismanagement alone. They are the collapse of expectation. History is replete with examples. Weimar Germany, post-revolutionary Russia, and Zimbabwe in the early 21st century all demonstrate that debt exists only as long as society believes in its value. Without that belief, the ledger is meaningless. Yet there is a resilience built into the system. States have learned over millennia how to maintain credibility. Taxation, regulation, control over currency, and the careful calibration of debt issuance allow governments to extend obligations further than the individual imagination might tolerate. It is a delicate balance. Too much debt risks panic, too little may stifle growth. The art of state finance lies in sustaining faith over generations, in ensuring that the web of promises continues to support life, trade, and progress. For the individual, the lesson is subtle but profound. National debt is not a burden in the same sense as household debt. A country cannot run out of money in the literal sense. Its obligations exist in the space between expectation and enforcement. The danger is systemic, not personal. Societies can adapt, restructure, and redefine the terms of debt, but only if they understand that money is not a finite thing, but a shared belief codified in law, habit, and tradition. In the end, the paradox resolves itself quietly. Every nation is in debt. Every bond has a holder, yet the true creditor is neither visible nor tangible. It is the human capacity to believe in continuity, to trust in systems larger than oneself. The ledger is vast, the numbers immense, but what underpins it is surprisingly simple: trust across time and space. History has repeatedly demonstrated that faith in institutions, more than gold or silver, sustains civilization. Without it, debt collapses, economies falter, and societies are forced to start anew. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.